So last week we spoke of, was it last week? Yeah, on Friday, we spoke of double tops, double bottoms. I made some illustrations and I showed you practical examples on the live charts. So today we are going to look at those ones were external range liquidity. So now we are going to look at internal range liquidity. So when we talk of internal range liquidity, these are some of the things we are looking at. We are looking at fair value gaps. We are looking at liquidity voids. And we are looking at what we call volume imbalance. I'll show you examples. Fair value gaps. Maybe you should write these things down. So we have fair value gaps, we have liquidity voids, and we have what we call volume imbalance. These are all forms of internal range liquidity. So let's look at them one by one. First of all, let's look at fair value gaps. We'll look at fair value gaps, then we'll look at liquidity voids, and then we'll look at volume imbalance. Then I'll explain to you their significance and what they mean when we see them on the charts. Okay, and what price does when it goes to fill them or gets close to them. So let's get started. Let's start with fair value gaps. Let me see if I can do some illustrations before I show you examples on the live chart. So let me do an illustration. I like doing illustrations because they look practical. Let me change background. Let me increase opacity. So it looks like a bearish candle. So let's say we have this. This is a wick or a shadow. That is also a wick, aka shadow. Now, to the left of this candlestick, let's say you have something like this. Now we are looking at this, assuming that price is coming from above, like this. So price is bearish. Okay, we don't need that. Let me use the arrow. Okay, so this candlestick, we have a wick here. Then over here we have a candlestick, and probably that one is bullish. So I'll change the color, something like this, something like this. Now look at something. When you look at the middle candle, you realize that it's a bearish candle, and you realize that there was intense selling. Okay, so it doesn't matter what time frame you are looking at this one. Let's say if you saw this on a daily time frame, that means that on that day there was a lot of selling, many more sellers in the market than buyers. That is to say that the selling volume in the market was far greater than the buying volume, and so the market moved down, like you see on this candlestick. Now you have a candlestick to the right of it, to the left of it, and another one to the what? To the right of it. What's a fair value gap as far as this example is concerned? Look at this candle, the middle candle. Then look at the candle to the left. Look at the candle to the right. If you look at the candle to the left, look at the lower wick. This is the upper wick, and this is the lower wick. Look at where the lower wick is. Now look at the candle to the right. Look at where the upper wick is. The distance or the space between this lower wick of the candle to the left and the upper wick of the candle to the right is what we refer to as the fair value gap. And this is how it looks like. This is how I draw it. I take my rectangle, then I draw from that wick, then I extend to the right, like this. Something like this. Okay. If the market moves from this direction, this way, and then it goes in to fill this gap, especially if it is happening at a resistance level, if it fills this gap, you're likely to see the market do this, come back down. Why? Because there was price inefficiency there, and they have gone in to correct it. Sometimes the colors can be the same. The candlesticks, sometimes the colors can be the same. Sometimes they are bullish and bearish combined. Sometimes they are only bullish, and other times they are only bearish. Okay. But this is how a fair value gap looks like. So it's a space between the wick of the candlestick to the left and the wick of the candlestick to the right. So the market trades into it, fills it, and then it starts to go back down. So this is how a fair value gap looks like. Space in there shows us that there's price inefficiency. There's an imbalance there. So when the market goes in to fill that gap, that imbalance is corrected. Then it starts to what? It starts to drop. Let me show you examples in the live chat. But before I go there, do you understand my illustration? If you do, type here. So I'll show you live examples. Let's go to. They are very common. You see a lot of them over and over and over and over again. I'm going to show you examples of fair value gaps that got filled and then the market responded. I've seen some examples, but those ones are yet to be filled. I'm going to look for ones that got filled. Now look at something. Look at this candlestick. You see the candlestick I have highlighted. That's on the daily time frame. This was intense selling, and that's unhealthy price action. There was serious selling on that day. Which day was that? 8th September 2020. This is a daily time frame. So on that day, there was serious selling. So that's how the candlestick, that is what the candlestick is suggesting. If you look at it, it doesn't even have a lower wick. Look, it doesn't even have a lower wick here. Just a small upper wick and then a long body. Let's calculate the number of pips from this lower wick, this little upper wick down to this level. That's 189 pips for one candlestick. So now where is the fair value gap? The space between these candles, lower wick, this candle's lower wick, that's a candle to the left of this candle, and this candle's upper wick, that's a candle to the what? To the right of this candle. So how do you draw it? You take your rectangle, you draw from here, then you extend it down. We can extend it further right. And then you see what will happen when in future the market went in to fill that gap. Look at something. Over here, they completely filled it. They went in to fill the gap. You see, they completely filled it. And I would have sold this because besides the fair value gap that got filled, there was also a bearish order block or a breaker. That's a breaker. There was also a breaker right here. So this would have been a very nice place to sell. So you see, they filled the gap, traded down nicely. Then the buying continued. It was generally a bullish trend. But after filling the gap, they traded down and then found support somewhere here and then continued going back up. Let me show you another example. Even right there, we have another example. Look at this candlestick. This intense buying, serious buying. Where's the fair value gap? The distance between the candlestick, the upper wick of the candlestick to the left and the lower wick of the candlestick to the right. This is it. You see? So after that sell opportunity, they came down to fill this one. Someone is asking what's a breaker. It's a whole concept. Please go and watch my video on order block theory. It's a whole concept. I don't have the time to explain it now, but there's a video on it. The title of that video is order block theory. So please go and watch it. It's a whole topic on its own. We cannot solve it today. So you see how they came down to fill this gap. Now I'm trying to find out exactly why they started to move up from here and not here. Oh, okay, I see it. There's a reason. After filling that gap, I like this type of setups where after filling the gap, they trade into an order block. That one gives me more certainty about the trade. That's another block right there. So they filled the gap, and the gap was the space between this the upper wick of this candlestick to the left and the lower wick of the candlestick to the right of this bullish candlestick. So we filled it, traded into the bullish order block. You see the sharp rejection, and they moved up aggressively. That's an example of a fair value gap. Let's look for this. I want ones that got filled. Okay, there's another example here. And note that this exists on all the time frames, whether it's monthly time frame or 1 minute time frame. Look at this candlestick. Intense buying. This is one of the examples where they were all of the same color. So you have the fair value gap is the gap or the space between the upper wick of this candle to the left of the bullish candlestick and the lower wick of the candle to the right of this bullish candlestick. So this is our fair value gap. Like this. You extend it to the right because you want to see what will happen when the market trades into it. What did the market do? Traded right into this bullish order block. There was a bullish order block there. There was also a breaker here, or should I say a break in market structure. I think I'll go for the breaking market structure. You see? So after filling the gap, traded into the breaking market structure, what did they do? They moved up aggressively. So I like this type of setups where they fill a gap and then trade into a bullish or bearish order block or a breaker. That is very powerful confluence. So that is another example of a fair value gap. Let's look at a few more examples. This is an example, but it's not completely filled yet. This one. They filled a small portion of it. Let me see if the market ever came back to it. Nope, it's yet to. They filled just a small portion of it. Yes, look at this. This is an example. This candlestick, the distance between here and here, that's a fair value gap. Look at where it happened. A mitigation area. Here is a mitigation area. I explained in the other block theory video what a mitigation area means. This place is a mitigation area. And right there, we have the fair value gap. So you see, they filled the fair value gap. And what did they do? Came right down. Came right down. So if you sold from here, if I were involved in this trade, this would have been my target because there's another fair value gap here. So my TP would have been somewhere here. That's where the fair value gap ends. So my TP would have been 1.23953 if I had entered this trade. That would have been my take profit because I know that after filling the gap, they can move up aggressively. So I'll get out from there. So that's another example of a fair value gap. They are very common. They are very, very common. You see them all the time on all the time frames. Let's look at current price action and see if there's any fair value gap. This is obviously a fair value gap. There's one here too. That's why I was thinking Euro USD would trade into it. It came down, then it decided to do its stance. It went back up. There's a fair value gap. So one of the reasons I was anticipating that they will come down to fill that gap, then find support right here at 1.19157 go up. But the week just began, so let's see. It could likely trade back into it. It's possible. It's very possible. And you see, this is an example of a fair value gap from the weekly time frame. This Euro USD. This is it. This is a candlestick. This one. So the distance between the wick of the lower wick of the candle to the left and the upper wick of the candle to the right, that's a fair value gap. So you can see that when they traded it, there was some reaction because Euro USD dropped today during London session for about 119 pips. Traded into this bullish order block, then there was some form of rejection. It started going back up. This is an example of volume imbalance that we'll be looking at here. So I will not get off this chart because I'm going to talk of volume imbalance next. Then we'll continue. I'm looking for examples of fair value gaps that go filled. Now, there's something you must know. The fact that when fair value gaps get filled, price reacts and starts to go in the opposite direction does not mean you should just make a trading decision because a gap is filled. No. The trend is the boss. That's why I always tell you, that's the first thing you must look at. That's why I said you must understand market structure. If you understand market structure, it will be easier for you to identify trends. Okay. So if the trend is bearish, then fair value gaps that are in good sell zones are very likely to hold and the price will move down. But if the trend is bullish, fair value gaps that are in good buy zones are likely to hold and then the market will go up. But in a bullish market, if you see a fair value gap in a sell zone in that bullish market, it's not likely to hold because overall the market is very bullish. I hope you get me. So though these show us price inefficiency and imbalance in the market and gives us good ideas as to where we should enter our trades, we must make sure that the fair value gap is in conformity with the trend. Okay, it's in conformity with the trend. So take note of that. I want another example of a fair value gap that got filled. There's one here, got filled, but it still came down to do a turtle soup sell model. So you would have seen the fair value gap, and you would have also seen or known that we have equal lows here, which is also a form of, we spoke of that one last week. So you would have taken note of this activity. So you see what happened. They filled the fair value gap, came down to clear the lows here. I bet you this was a double bottom. So anybody that sold on this line, there's a weekly time frame, sold on this line, if they were still holding on to their trades, would have had a 184 pip drawdown. Most traders will be out by then because that is a lot. It's too significant. So anybody that sold here, or sorry, that bought here, would have their stop loss taken out. Yes, would have their stop loss taken out. And very few traders will hold a trade for 184 pip drawdown. Most traders will be out by then. That's why I keep telling you, yes, double bottoms signal that there's going to be a buy opportunity, but you always have to wait for them to clear the stops or clear the liquidity there before you enter the market. So this is a typical example of them filling the fair value gap, clearing the equal lows, and then forming a nice turtle soup buy model. Then the market went up.